Okay, so to wrap the fundamental analysis section up, we go into qualitative analysis. This is, look, we are living in a time where there's a lot of investment being made in algorithm trading, quantitative trading. There's a lot of money being poured into developing robots, high frequency trading algorithms that can quickly analyze a lot of quantitative data, a lot of numbers, and immediately produce traits out of that as a result. So I always say there's still an edge for humans in qualitative analysis because it's much, much harder for an algorithm or a quant to come up with strong qualitative analysis on a stock. So this is where still humans, if you will, have an edge in trading. So when we talk about qualitative analysis, we usually focus on five main factors: the business model of the company, its competitive advantage, its management, its corporate governance, and the industry they're in. To start with, we have to understand the business model of the company we want to invest in. What exactly does a company do? This is information that you need to know, and it can be found at the beginning of the 10K filing or the company's website. But you should always understand what the actual business model is. If it looks too complex to you, it's probably better if you do not invest in it. You have to understand how the company makes money before you jump the gun. Okay. As a fundamental analyst, it's better to stay away from sectors that you do not understand or you do not have enough information in. For example, Warren Buffett does not invest in tech. Why would he not invest in tech stocks, which have been, probably one of the fastest growing stocks around? Well, the reason is, he's an 90-year-old guy in Nebraska. It's not his thing. He does not understand tech. He does not understand how these companies make money, what the business model really is, and he doesn't need to invest in them. So he will invest in Coca-Cola. He will invest in insurance. He will invest in railroads and things that he understands and he can comprehend and analyze fully. So I would say the same thing. Do not try to invest in companies in which you do not understand how they make money, and actually dig deep into what they actually do to make the money. Because sometimes, a company can look like they're making money from one thing, and in reality, the business model makes money from a very different thing. McDonald's, for example, is a pretty good example of that. People assume McDonald's makes money from fast food, and the reality is a huge chunk of McDonald's profit is actually real estate gain. Okay, because they lease the properties back to their franchisees and all these things. So it's actually, in a way, more of a real estate play than a fast food play. So these are things you have to take into account before you start investing in companies. Okay, so be careful and understand this. Invest in business models that you understand and that make sense to you. This is also very important. You guys are all customers. So if you like companies and you understand how they make money, that means that you already have some firsthand information. So I always tell people, hey, what is your favorite product out there? What is your favorite service? What do you really like using? And do you understand how the company that supplies that product or service to you makes money? If so, that might be a good first stock that you can analyze rather than trying to chase an obscure biotech company that you do not understand the business model of. Okay. Using your own personal or professional experience can actually enlighten you a lot about the company's business model prospects. For example, if you're knowledgeable about the oil and gas business, you will be much better prepared to assess the value of a business model of an energy company than if your background is in restaurants. Okay, so these are things that you might already have some information on. Maybe it was because you worked in a company like that. Maybe it's because you have had a huge interest in the sector and you've read a lot of it. Maybe because your college classes have been linked to that sector. Maybe because your parents work in that sector, or maybe because you're just really, really interested in something. Okay, but I would say try to pick one or two, become an expert in a couple of fields. Okay, good fundamental investors tend to have an industry that they really understand. which means that they can assess business models better than those investors that are just generalists and they try to invest in a bunch of companies that they don't really understand. Okay, so if you're really into fundamental analysis, I'd say, hey, pick 2 or 3 sectors that you like, that you have some information on, that you are interested in. Develop some research, develop some research skills about these sectors, and you'll be able to analyze companies in that sector from a fundamental point of view in a much better way than most. Okay. Obviously, if you're a short-term trader and all you care about is buying today and selling, a week from now, that's irrelevant. Okay. And probably you're not going to be using fundamental analysis too much. You're going to be focusing more on the technical side and the event-driven side and the volatility side. Okay. But just if you want to do some long-term bets, some fundamental analysis, it's good to pick a couple fields that you like and become a mini expert on those fields. Another very important factor is what's called the competitive advantage of the business. This refers to a company that's both operationally more efficient than the competition and therefore is better positioned strategically. Aspects like having a respected brand name, Coca-Cola, Apple, pricing power, it can influence the industry's pricing, large position of market demand, etc., creates, as Warren Buffett puts it, a moat, okay, thing that surrounds a castle, right? That creates barriers from competitors to access the industry, okay? So it's important to try to pick companies that have a moat, okay, that protect those companies from competitors, and therefore they're probably the strongest companies in the sector. So what are common sources of moat? Well, one of the interesting sources is low operating expenses in relation to sales. So for example, Walmart can, because of its sheer size, negotiate down prices from their suppliers very significantly, which makes them able to price their products lower for their customers, which makes demand for Walmart products increase and the competition suffer, which makes Walmart bigger, which makes them more able to lower the prices even further from their suppliers, which makes them even more attractive, and it's sort of a golden cycle. Okay, so having that position is quite important. Also, having patents, brands, licenses, things that protect the intellectual property or the production process from the competition will allow a company to charge premium prices for their products. Okay, that's true for pharmaceuticals. If they have a patent on a drug, they'll be able to charge a much higher price for a while. Brands, Apple is able to charge much more than Samsung, for example, because Apple has a more powerful brand. Okay, that's essentially the main reason. Luxury clothing, prime example. There's cotton T-shirts out there that cost $1 to manufacture, but people might pay $70 for it if it has a brand name on it. Why? Because it has a brand name. So these are things that make it very hard for competitors to try to compete with these well-established names. Okay, so it's good to invest in well-established names. A third is, for example, situations of efficient scale or other monopolistic structures. If you essentially have a monopoly on something, you're quite well protected. Let's say, for example, that your company owns all the fiber optic cable in the town. Anyone who wants to compete with you will try to either build that infrastructure themselves, which is extremely expensive, or rent that infrastructure from you, in which case you'll still have the dominant position. Switching costs is actually a very, very interesting one. And this is when it is difficult for customers to switch from one brand, from one company to another. This is a classic in the software industry. That's why a lot of software companies will offer free demos, to businesses, for example. So let's say a business wants to, buy sales software for their company. Sales software company will come and say, hey, I'll set this up for you for free, and you'll be able to use it for a year without paying us anything. And the reason they do that is because they know that after 1 year, after all the employees have been trained in that software, after they've been used to using those tools, they're not going to want to change. Okay, there's switching costs. It makes it burdensome for people to change. During the 90s, for example, Microsoft did that in a very smart way. There was a lot of counterfeit, like, you know, you could download Microsoft Word, for example, illegally for free everywhere for many decades. Thing is, Microsoft knew that, and they didn't really stop it. And the reason was because they assumed, rightly, that whole generations of people were getting used to using Microsoft Word, for example, as a word processor. And those people, when they grew up, even if they were buying a MacBook, they were still paying to download, you know, Microsoft products, Microsoft Word on their Macs rather than using Pages, for example. Okay, so this is an example of, in a way, switching costs, because you know, once you get used to a certain program, you don't really want to change it if it already works for you. So it's smart companies that do that and do that smartly have moat. Okay, it makes it harder for competitors, even if they have a better product or a lower price, to compete with them because people are already used to you know, to the initial product. And lastly, we have the network effect. And the network effect is especially relevant in tech. And this is when the more people that use your product or service, the more valuable it becomes. And therefore, the harder it is for someone to compete with you. This is what Google, this is what has made Google such a powerful company. They have a network effect, meaning everybody, or like most everyone, goes to Google when they want to look up for something online. It is the preferred search engine. And because so many people use it, it is very valuable, and it can charge a lot for, you know, companies to be displayed in a you know, higher position or sponsored rank or whatever. Facebook is also a classic example of that. Why would Facebook be valuable if it were not for the people that have accounts with them? When I say Facebook, I mean it's Facebook Corp, not just Facebook software, the platform, but also Instagram, for example, you know, which is owned by Facebook. Instagram would be worth nothing if nobody was on it posting pictures. Okay, so the more people that use your product, the more valuable you become, and the harder it is for competitors to try to just steal some market share from you. Another component is management. Some fundamental investors actually believe that management is the most important aspect when deciding an investment. And after all, it's true that it can make a big difference if the person running the company is very competent or that person is a disaster. Okay, this happens with politics. It happens with certain projects. It doesn't really matter. Like you want the person behind that operation to be competent, to be, you know, highly skilled in what they're doing. So there's actually hedge funds out there that really look at management as they're one of the main factors they choose when allocating funds for investment. And in a way, like if you look at how the startup world works, for example, where, you know, people pitch ideas to angel investors or venture capital firms, they will look at the idea, sure, but they will also look at the person behind the idea, and they will invest really in that individual or that team of people, because, you know, it really makes a difference. I mean, you could probably look at your class and sort of, you know, predict the most successful 5 or 10 people, you know, 10 years from now. So if you knew that those people were starting a business, you know, you might want to invest in that business. Okay, so that's what we're talking about here. Management is that human quality behind the company. It is true that for small investors, it is very hard to analyze. You can't really call the CEO up and meet up to discuss a company with him. Some hedge funds do that, and it works well. But for retail investors or small investors that do not have access to management interviews, you can focus on things like the conference calls. So every quarter, you know, when the companies are supposed to present their earnings, they will have a conference call. During the first part of the conference call, it's them just reading the financial results. It's quite straightforward, quite boring. But then the second part includes a Q&A session, where people, usually analysts, will ask managers questions about the company. And it's interesting to hear how management answers those questions. Are they, you know, are they straightforward? Do you get an honest feel from them? do they seem competent when they're answering, or are they trying to avoid questions? Or are they trying to, make it not very transparent? Because those would be bad signs. Okay, getting honest, straightforward answers. Those are the things you wanna hear. Another interesting area you can focus on to try to see if management is of high quality is looking at the MD&A. MD&A stands for Management Discussion and Analysis, and it's found at the beginning of the annual report. And it's supposed to be commentary from management. It's usually rehearsed and quite standard, but sometimes it's interesting to compare with the previous years. So, have they changed? Are they just repeating the same thing over and over again? If they are, it probably means they're not really forward-looking people necessarily. They're just repeating the same old general phrases they've been using for years. Okay, you want management that really shows you how the company's doing and what the plans are for the company. Then we have management, ownerships, and transactions, and we'll talk about this a lot when we do event-driven analysis. But it's also a good sign if the company is run by the owners, or at least they have high percentage of equity. Um, and of course, if they bought shares of the company themselves. So we'll talk about this when we do event-driven. And then just simply looking at past performance. How have the managers done in the past? How have they performed? Did the companies they managed, did they grow or did they not? Were they wrapped in scandal and losses, or were they successful? So this is, it's you can go out online, you can look at the biography of that person, you can look what they've done, and you can look at their track record. And more often than not, you'll get a pretty clear idea of that person's quality, at least on paper, and competence. Then we have corporate governance. I don't think this is too significant, but it is true that it gives you an idea of how the company is run, and how respectful they are to the owners, the shareholders. There are policies in all corporations that establish the relationships and responsibilities between management and the shareholders. And their purpose there is to make sure that there are checks and balances in place, so no one person in the company can conduct illegal or unethical activities that would harm the shareholders, or even not necessarily illegal or unethical. But imagine that a company CEO decides to give himself, a 70% raise every year, or allocate insane bonuses. At the end of the day, they're a worker. You, as a shareholder, are the owner, and you need to hold those CEOs accountable, and make sure that the corporate governance allows you to do that in a clear way. So the main areas that are important to an investor are mainly three. One, financial information and transparency. The quality and timeliness of the financial statements. They need to be clear, and they need to be created in a way that allows the shareholders to know what's going on. So, for example, if we're analyzing a company and we see a financial statement that is clearly trying to hide some losses, or cook the numbers a little bit, that's a bad sign, because they're lying to us, and we are the owners, and we deserve to know exactly how well the company is doing. Okay, so you want clear, financially transparent information. Another area is the stakeholders' rights. So how important is the voice of shareholders in the board meetings? What voting rights do we have? What are the takeover defenses? Things like that. Again, they're not too significant, but it does give you an overview of how the corporation is run. And finally, the structure of the board of directors. Now, the board of directors has, like, the main function of a board of directors in a company is to check on management, and make sure that the interests of the shareholders are being taken into account. It is problematic when the board of directors is not independent, or is filled with insiders. So, for example, if I see that the board of directors in a corporation is made up of the CEO's brother, his best friend, his mom, and his wife, I'm probably not going to be too enthused about that company, because I'm not going to believe that the board of directors will keep that CEO accountable, because essentially it's placed as friends in the board of directors. Okay, so you want people on the board that are independent, that have good track records in their sector, and that overall can keep the CEO in check, okay, or general management in general. You can find the information who sits on the board online or in the DF 14A statement. And finally, the industry itself. So which sector is a company in? And within this, it's interesting to look at, for example, customers. So the wider and more diversified the customers in one industry or company, of course, the better. For example, if we're talking about a sector like military companies or even airlines, they tend to rely on a small number of customers. In the case of military, sometimes they rely on one customer, and that is the federal government, period. That is risky because, for example, there's a change in federal policy and defense spending is cut, that company is going to suffer immensely. Or, for example, if Foxconn, which is a company that manufactures Apple's products in China, since they derive most of its revenue from one company, that is Apple, if Apple suffer, they suffer. So try to see if the sector you're in tends to have a wide number of diversified customers, or is actually just a small number of them. Because if it's a small number of them, you got to be careful. Now in the 10K, in the annual report, the company needs to disclose if most of its revenues comes from one single customer. So there's the information there. Market share is also important. So having high market share is seen as a positive phenomenon. Okay, it can contribute in creating moats and economies of scale. And in most industries, being the biggest player creates barriers to entry from smaller players and make the big player much more efficient and therefore bigger in the future. Okay, so usually the more market share you are, the stronger, the bigger you are, the better you tend to be in the future. Okay, it's one of those things that the small competitors have a hard time competing with a company that already has a huge market share. Industry growth is, of course, very important as well. So will the market for this industry grow in the future, remain the same, or even decrease? Okay, industries come and go throughout history. And from a growth perspective, it is not a good idea to be stuck with investments in declining industries. Okay, if you feel that there's a clear shift towards renewable energy, and you have a lot of oil and gas or coal stocks, this it might be smart to take that into account and maybe hedge those positions with positions in sectors that might grow more in the future. Okay, if, for example, companies in industries that have completely disappeared, that was the example of the traditional cameras that died. People are now using cameras on their phones or using cameras that are digital. Nobody's using developing companies where all these things they've vanished. Same with the CD industry is probably going to die soon. Floppy disks back in the 80s, you're probably too young for that, but all these things have disappeared. So it's important to be in industries that are growing. Competition is also important. So how many players are there in the industry? What are the barriers to entry? How is the competition? How capable are they? How big are they? And what sets your company apart from the rest of your competitors? In sectors where there's a lot of players and a lot of players are very big, obviously you're going to have your company might have a tougher time competing. Whereas if you're in a sector where you dominate 80% of the market share and there's a bunch of small companies that have the remaining 20%, well, you're in a very strong position. That would be, for example, Google's case. They dominate completely the search engine market, and you can have Yahoo or some other smaller competitors trying to compete with that, but they're not really getting anywhere. Okay, and finally, regulation is also important, especially in some industries. For example, in the utilities or pharmaceutical industries, government regulation can severely impact a company's prospects. Okay, so be aware of possible regulatory changes in the future. This also links with event-driven analysis, which we'll see later on. Okay, But obviously, if you're investing in sectors that are heavily regulated and therefore rely on a lot of government laws to operate, um, that's something that's a risk you have to take into account. Okay, and for example, you are predicting that regulation in that sector might get more strict or more limiting. Maybe that's not a sector you want to invest in. Okay, and so essentially, as the overview, we've seen there's two main uh, types of fundamental analysis: the quantitative analysis, and that is linked to its income statement, balance sheet, and the cash flow statement, and the valuation ratios, and the qualitative, okay, based on the business model, the competitive advantage, the management, the corporate governance, and the industry itself. Okay, next video we start with technical analysis.